Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio. With budget just around the corner, MF Corner today will focus on what the industry is expecting from the government when it comes to taxation on different asset classes in the particular industry. Now remember, we did see a change in debt mutual fund taxation last year, where the indexation benefit was taken away and gains will be taxed at par with the fixed deposit returns and at slab rates. But there are some asks, especially when it comes to different holding periods, different tax rates or different asset classes as well. So we'll discuss that with our guests today and the experts on the show as well. But before we do that, let's just revise the tax rates that we have right now in terms of mutual funds and the holding period as well. Now, for equity funds, short-term capital gains are for a period where the asset is sold within 12 months, and it is long-term capital gains if the asset is sold after 12 months or longer. For debt funds, it's always short-term. This is, of course, after 31st March 2023, last year when that change came about. For hybrid equity-oriented funds, again, it's called a short-term capital asset or a gain or a loss when it's sold within 12 months. And if it is more than 12 months or 12 months, it's a long-term capital gain. For hybrid debt-oriented funds as well, it's always short-term. But always remember, long-term capital gains of up to 1 lakh are exempt from taxation. Now, when it comes to the rates as well, that is very important. For equity mutual funds, for arbitrage funds, it is 15%, which is the short-term capital gain, and long-term capital gain is 10%, but without any indexation. Other funds would be that invest at least 65% in equities, but for debt mutual funds, as we pointed out, it's always the slab rate on which it is taxed. If you talk about the other funds, be it conservative hybrid funds, again, it's always the slab rate. For the floater funds, which will basically invest at least 65% in floating rate instruments, it again is slab rate. And for aggressive hybrid funds, which will have equity component between 65 to 80% and debt component between 20 to 35%, it is 15% on short-term capital gains, but 10% on long-term capital gains. But again, there is no indexation available here. So these are the broad numbers and the broad rates that you need to remember. But let's get in the experts on the show today. We have a power-packed panel. Let's welcome Harshvardhan Roongta of Roongta Securities, Amarpal, Chadha, tax partner at EY India, and Sushant Bhansali, Chief Executive Officer at Ambit Asset Management. Gentlemen, thank you so much for joining us today. And you know, we just saw some visuals as well of the AMCs, of brokers and the associations meeting Finance Minister Nirmala Sitharaman ahead of the budget session. So there have been a lot of asks. But let me come to you and start with you, Mr. Chadha. A lot changed last year, but in terms of mutual fund industry, what are some of the major asks that the industry has when it comes to budget changes?
Sure, Sonal. And you're right, there's been a very big change last year. So the entire scenario around debt has become very difficult. Whatever we are hearing from, and typically for the mutual fund from the AMFI, the association has put across a charter of changes that they are looking at. And I think top of the list is that if the switches between a regular plan or a direct plan, a growth or a dividend plan, could that be eliminated? The tax element out of a switch could be eliminated. That's one thing which the lobby is expecting and is pushing for. I think the other one, the bigger one, is also the uniform tax rate for capital gains. So can the tax slabs be reduced, or can the tax categories be reduced so that the capital gains taxation becomes simpler? There is also one very interesting ask by the MFI around debenture-linked savings scheme at par with the equity-linked ELSS scheme. So these are the typical three demands that we are seeing the AMFI make. But I would say top of the list would be the switches, because that would make it easier for everyone. Given that debt doesn't have much options, there could be a push even for a DLSS kind of a scheme. So Sonal, these are the three things I think which is being pushed.
Oh, yes. And, you know, we'll discuss them in greater detail as well, especially on the debt side, because as we've been talking about the big change that happened last year, so maybe this could be a way to, you know, push this particular category as well. Mr. Bhansali, let me come to you. I wouldn't ask you specifically about mutual funds, but there are other aspects as well where assets are management, be it PMS, be it AIFs. What is the broader demand or the expectation that there is from the government this time?
Sure. Thank you, Sonal, for calling on the show. As expected, I think the government's intention has been quite clear last few years. They've tried to rationalize and take out gaps, if at all, in the taxation side across categories. They want mutual funds to be savings. They want insurance for protection. They want banks to be the lenders. That's why I think they've been changing the tax rates to both enable savers to use mutual funds as well as persuade them to go from debt products to more to banks and from insurance production companies. From the perspective of PMS and AI, I think there are still some gaps and anomalies left compared to mutual funds and within AIFs different categories. One of the top demands on the AIF side has been to get category 3 AIFs, which invest primarily into equity markets, to bring them on par with category 2 and probably mutual funds as well on a pass-through basis taxation structure. Right now, the fund has to pay the taxes at the maximum marginal rate. And, we want this anomaly to be probably removed and get it in line with mutual funds and AIF category 2 with a pass-through structure, whereby investors will pay their own taxes depending on their own tax rates. So that's point one on AIFs. The second, on the PMS side, there are two things. First, probably the fees of PMS managers. That is right now not a deductible amount for most of the cases. It's not sort of a gray area, but a clarification will always help as part of rules and regulations within the taxation structure. If it gets crystallized, to treat that as an expense like what happens in mutual funds or AIFs. And the third, on the PMS side, I would say that if mutual funds, if they are also charged tax on exits and churn from the PMS to another PMS rather than at the churn at the individual script level, like individual investors. So treat them alongside as professional managers, as PMS. So those, I would say, will be the key demands from the industry on PMS and AIF sides.
Okay, all right. Very comprehensive. Thank you for that. And we'll discuss that in greater detail as well. But Mr. Roongta, let me come to you because there are a lot of things that the industry wants. We don't really know what would go about, but some of the top demands that the industry you think should ask for or is already asking for.
So, Sonal, I mean, there is a tax abnormality with regards to the gold funds. So, if an investor, and gold has become a popular investment option with investors, 2023, when in April 23, when the changes were effected with regards to the taxation funds, I mean, gold, I think, became a collateral damage, the gold funds typically. So, as of today, if an individual was supposed to invest in physical gold, if he or she holds on for 3 years, there is a long-term capital gains implication, which is 20% with the tax benefit. And with regards to gold funds, because the equity component is less than 35%, as you had rightly posted on your initially when you started with the tax slabs, the gold funds are taxed even if it is more than 3 years. The investor is taxed at slab rates, whereas if you're holding physical gold, then your taxation is different. For long-term capital gains is 20% with indexation benefit. So I think this collateral damage needs to be sorted out, and Finance Ministry would need to come out with some regulations and clarification rather to say that gold funds are out of this purview. With regards to other big bang changes, I don't think the government would want to make shake the apple cart. Retail investors have just started to make money into the equity markets, so I think there has to be some rationality with regards to the holding period. So, we've been talking about capital gains tax being increased, and I really hope they don't do that. And instead, they could most certainly consider increasing the holding period to say probably 2 years for qualifying to long-term capital gains. I think this is one thing that is expected to happen. With regards to ELSS and DLSS, I don't quite honestly see the Finance Ministry introducing a new tax exemption provision purely based on the fact that, because there is an ELSS, why not have a DLSS kind of a thing? Because the push of the government is anyways onto the direct tax, the new tax regime. So I don't see them introducing a new category at this juncture where they are planning to take away all the exemptions under Section 80C.
Okay, all right. So there are a lot of things which are asked for, but maybe all of them won't happen. But Mr. Chadha, let me come to you because we spoke about DLSS and ELSS. So just taking that point forward, one, do you think there's a possibility that ELSS tax benefits could be done away with because there's so much focus on new tax regime? And if not that, do you think DLSS is still a far ask and that is not something that could happen immediately?
Yeah, I think, Sonal, a lot of guesswork is happening and a lot of representations are happening. So if I pick up today's recommendation from FICCI, PhD, all of them, there'll be too much of a ask. But your point is absolutely right. The focus is now on the new tax regime. And we all know under the new tax regime, ELSS doesn't exist. You don't get any special exemption for that. So if that is the focus area, will government sort of take a step back and bring in another scheme which is aligned to an old tax regime like a DLSS? I think that's a question which the finance minister would consider twice before recommending. So I think it's everyone's guesswork, but seems difficult given that it's not aligned to the new tax regime.
Okay, that is again a question that has been going on since the time the new tax regime was introduced. But gentlemen, hold on. We have to take a quick commercial break. We'll come back with more queries and expectations on the budget. But as we do that, let's leave you with some important commentary. Finance Ministry has started consultation meetings and today financial sector and capital market representatives met with officials at the North Block with their budget wish list. Let's listen into what suggestions were given by Raman Agrawal, the co-chairman of Finance Industry Development Council, specifically for AMCs besides other areas.
Yeah, so primarily it was the participants from the capital markets and NBFCs, and yeah, so there were no banks today except for Mr. Atul Goyal, who was there from the Punjab National Bank. So from our perspective, we've made 3-4 quick points. One, we said that now that the sector has grown to be 12.5% credit to GDP ratios, there stands at NBFC credit. And so there is a case to look at the funding because RBI is saying there is concern over dependence on banks. So that is where we raised that we need to have a direct handle for the government. So maybe a allocation of funds done to SIDBI or NABARD to do refinancing to NBFCs. And second point, we said since now the regulatory framework for NBFCs has been harmonized with that for banks, that remains incomplete if you are not given recovery tools like SURFACE. So that point, Madam did react also that we need to look at how these anomalies can be removed. AMCs basically they are talking more about how to encourage more. So a lot of discussion on the gift city part also. How do we ensure that the whatever capital should not be going out of India? How can we retain more that in India? And there were also suggestions made on some of the arbitrage funds.
Won't pay.
Welcome back. You're still tuned into MF Corner. We still have with us Harshvardhan Roongta, Amarpal Chadha and Sushant Bhansali. We are talking everything about budget expectations this time around when it comes to the mutual fund industry. Mr. Roongta, let me come to you. You mentioned, Mr. Chadha mentioned the switching of units from one scheme to the other, which is attracting tax right now. Maybe switching from a regular scheme to a direct scheme or from a growth fund to direct fund, to a dividend fund. All of it is attracting tax right now. Do you think that is something which causes a big issue for investors and that is something that the government can look at?
So, well, Sonal, honestly speaking, my personal view, I understand the pain that an individual investor faces. So am I. Even I am into the same category that if I'm switching between two schemes, I have to make tax payment. But honestly, my personal opinion is I don't see it to be unfair, quite honestly. I mean, look at it from an operational standpoint. I mean, if the tax combinations, I mean, if the tax implication, they're trying to say that all switches made from one scheme, the same scheme from dividend to growth or the direct to regular are exempt from taxation. How are you possibly going to keep a track of all this? How the tax authorities are going to ascertain the tax liability with so many permutation and combinations? Anyways, there are so many confusing provisions in income tax that this could lead to further leakages. So while I wish it could happen, but I think it is quite too small to include it into the budget and ask the finance minister to make those changes just for the convenience of certain investors. So I just reiterate, I wish it could happen, but I don't see this happening because this will lead to a lot of leakages in tax.
Okay, all right. You spoke about a lot of provisions. That is also something that the industry has been asking for, right? How a simpler tax structure, simpler holding periods as well. Mr. Bhansali, do you agree with this? And are there any anomalies or do you think something that could be made simpler when it comes to AIFs and PMSs as well?
Definitely, I agree with Mr. Roongta in terms of tax leakage issues which one government might think about those problems. Though simplicity is best, but any which way, if investors is wanting to take benefit between dividend and growth, or between regular and direct, then definitely government needs to benefit from tax collection as well, as such. From a PMS and AI perspective, I think the other big things which we can probably someday get comment. One on Ambits and REITs, I think that's increasingly investable category for retail investors, for institutional investors. And there, if government can add some sweetener, probably that can make that category quite big. And remember, that category can pay and help a lot in the infrastructure creation within the country. NHA has done a great job getting the roads and the sets utilized through this road. And many other sectors like power transmission, etc., are also following the same. So if they can become much better vehicles, then infrastructure creation from domestic investors can become really big. Given that it's a non-equity allocation for all, it can also be a great saving potential, especially for senior citizens. So that's another one I think we would recommend.
Okay, and InvITs and REITs, they were in focus in the last year's budget as well. There have been a lot of changes in terms of compliance already that came about in form of clarifications. Mr. Chadha, let me come to you. You know, one of the asset classes which has been doing really well this year has to be gold. But again, there are too many tax rates here: physical gold, gold fund, or sovereign gold bonds. All of them are taxed differently. Is this a conversation that has been in place for a long time? And do you think this also needs some sort of clarification and changes?
Sure. And I think my panelist already covered the most important point on the taxability of the ETFs. I think barring that, today going for paperless gold in form of the sovereign gold bonds, it seems that's quite a good option for a retail investor to be invested in. One, definitely you get income from that, which is taxable, but a 2.5% income. No one minds having invested in gold and still getting a interest like a saving bank account. And with the superb advantage of non-taxability at the time of redemption. So if you hold the bond till the redemption, it's really from a tax efficiency perspective works well. Physical gold, very difficult to retain, a challenge, not a favorite with the current age group. But yes, the gold ETFs, I think was a win-win. Once the tax situation gets sorted, it will really be one of the easiest getting in and getting out option.
Okay. Okay. And you're right, like while this generation likes paper gold or digital gold more, nobody can take away from the charm of physical gold as well, right? So we need to look at the tax rates there as well. But take your point. These are some of the factors that need to be kept in mind anyway. Mr. Roongta, let me come to you. We had a lot more questions, but we have limited time as well. So around 2 minutes is what my director says. If there are any other changes that you suggest from the personal finance or the mutual fund industry that could be taken up or should be taken up, something that the industry, the investors want, but maybe it is not taken into consideration yet?
So, Sonal, I believe there are two areas which need very serious attention. So one is, I have been speaking about this since about 3 to 4 years now. There is a GST levied on Mediclaim premium, the premium that you pay for health insurance policies. Well, I think, it's the basic function of the government or the duty of the government to provide good healthcare facilities to its citizens. And very clearly, given our population and the health infrastructure, I don't think we are able to fulfill that requirement completely. So in order to encourage citizens to go in for health cover, I mean, Mediclaim premium and medical insurance policies are the only way. Well, the government does give you certain deductions in the form of Section 80D for the premiums that you pay, which again will be taken away in the new tax regime. So I think charging an 18% GST on that premium is extremely cruel. I mean, given the rise in the cost of medical treatment and subsequently the rise in the premiums that year on year, I think there has to be some mind put on to whether a levy of GST is necessary. If you look at the fiscal year 2023 data points, the total health insurance premium collected by the entire industry was approximately 90,000 crores. So the GST implication of that is about 16 to 17,000 crores. I'm sure our government in this current age and times can accommodate this 16, 17,000 crores worth of a GST in some other provisions. So I think this is something that I've been talking about since the last 3 to 4 years, and I'm hoping that there is something that will be taken up. The other area that requires a lot of attention again is the taxability on ULIP policies and life insurance policies. Well, there is a provision which says that if you're paying a premium up to 2,50,000 in a year in a ULIP policy, then the entire tax, the maturity proceeds that you will tax exempt. So there is no tax on that. We just spoke about a situation where the switches that you make into mutual funds are taxable. We're looking at all those kind of things. And on the other hand, you have a ULIP policy where an individual can pay 2,50,000 rupees in a year, and the entire gains that you make on that is tax exempt. Well, it doesn't kind of make sense when you have a product like a mutual fund being taxed and only 1 lakh rupees that you have on equities is exempt from taxation. And on the other side, you have 2.5 lakhs being paid over a couple of years. And all the gains that you make on that, on maturity, there is no capital gain whatsoever, where it functions exactly like a mutual fund where there are units. And the switches that you make in between that, whether you move from an equity to debt or debt to hybrid, there is no taxation whatsoever. Whereas we're talking about switch from a direct plan to regular being taxed here. So I think this kind of a tax abnormality needs to again be taken care of. And these are the two provisions which I think require immediate and urgent attention of the tax authority.
Okay, all right. Take that point. Gentlemen, thank you so much for joining us today. These are some of the important points that one needs to be aware of. Be careful of ahead of that big budget as well. And mutual funds, the industry has been growing. We are seeing big surge coming in retail investors and big surge in SIPs as well. So we'll see which way things go. But thank you so much for joining us today. We'll touch base with you again as and when there are more updates on this one. With that, we'll take your leave on this edition of MF Corner today. But stay tuned for Closing Bell to take you through the last hour of trade.